Good evening, everybody, and welcome to our webinar this evening. My name is Chris Entz. I'm a financial planner, a CFP, and a member of the support team here at Adviice. If this is your first time, welcome here. If you're one of our stalwarts, welcome back. We're always very, very pleased to have people join us on a summer Wednesday afternoon to chat about financial planning. Today, the topic of conversation is low income and low asset financial planning. So specifically looking at optimizing government benefits and clawbacks and how we can look at some different strategies around here. So I'll pass things off to Owen right away, but before we get started, just a reminder, please ask questions as we go. So use the Q&A tab at the bottom to send me questions and I'll feed them to Owen as we go through. We want these sessions to be as useful as possible for everybody. And so don't hold back, send us some questions. Thank you so much for coming, and I'll pass things on to Owen. Owen.
Perfect. Thanks, Chris. So yeah, my name is Owen Winkelmoen. I'm an advice-only financial planner, CFP, and the founder of Adviice. And as Chris mentioned, we're going to go through low income, low asset retirement planning in today's webinar. And if you've been on some of these past webinars, you've probably heard me say this. I do love retirement planning. I find it to be an extremely valuable point in a relationship with a client. And definitely the 5 years before, the 5 years after retirement can be extremely high value. Not just the financial planning portion of that, but there's obviously a big financial and life transition happening at the same time. So the psychological aspects, emotional, behavioral, etc. So a very interesting point when it comes to the financial planning process is retirement planning. Low income planning, low asset planning in particular, as we go through the webinar today, you're going to see the reason why it's so interesting is that often the rules are a bit backwards than you might be used to. So they are sometimes a bit counterintuitive. We're focused less on tax planning, more on government benefit planning. And you'll see why this type of planning, lower income, lower asset retirement planning can be one, quite valuable, but two, also a bit counterintuitive. Now, we're going to build on some of the stuff that has been done in the past by people like John Stapleton at Open Policy Ontario. So, some of the strategies we're going to share you can find in the guides that John Stapleton's already put together. Would definitely encourage you to take a look at that material as well. Now, as we go through here, we're going to start with some of the basics. This is counterintuitive planning. We do want to have some of the fundamentals in place, particularly around how GIS benefits work, guaranteed income supplement. So we're going to start with just an overview of GIS and GIS clawbacks, how that benefit works, what triggers clawbacks. We're also going to look at some strategies to maximize guaranteed income supplement, GIS benefits. We're going to go through two case studies together. So we're going to maximize a retirement plan for a single retiree with 200,000 in assets. We're going to do one for a couple with similar assets, but a 5-year age gap. And that's going to be very important as we go through. You'll see why that age gap ends up creating additional opportunities. Now, as we go through here, so when we talk about maximizing low income benefits in retirement, really we're talking about guaranteed income supplement. A lot of the complexity here for lower income, lower asset clients is really around maximizing these benefits. Guaranteed income supplement is the big one we're going to talk about, but there are other provincial benefits as well. In Ontario, there's gains, guaranteed annual income system, and there's also in Alberta, for instance, the Alberta Seniors Benefit. There are a number of additional sort of smaller value benefits depending on the province, but guaranteed income supplement is by far the largest. Usually, if we can optimize that one, we are also getting the benefit of those other income tested benefits as well. Now, this type of planning is a bit less valuable if you have very low income, very low assets. So when you don't have a lot to work with, there's just less options. There's still some options, so it's still valuable, but some of the strategies we're going to go through together will really be beneficial if you have somewhere between 50 and 250,000 in assets per person. And that number might surprise some of you. When we talk about low income, low asset retirement planning, that range is quite broad. I would say that if we're doing discovery calls, intro calls with potential clients, if somebody has 250,000 or less and they're approaching retirement, that for me is always a bit of a trigger to say, there might be something there around maximizing guaranteed income supplement. This can be a benefit that is, still available to even moderate income retirees. So we'll go through some of those strategies as we go through the webinar here. Any questions so far, Chris, at all?
Nope, none that we won't touch on in the
Cover?
next little
Okay,
bit.
sounds good. So the most value, as we said, are going to be for those people between 50 and 250,000 in assets per person. So a couple could be up to 500,000 in financial assets. And in particular, if you're between the age of 55 and 71, the reason why we say that is if you're below the age of 63, 64, for instance, you've got more options. You've got more time to make changes to your financial situation before OAS and GIS start at 65. So there is a period before age 63, 64 where you just have more options, and it's very valuable, this type of planning. If you can set yourself up in the right way, we're talking about tens of thousands, if not 100,000 or so in additional value. If you're between 65 and 71, there are options, but there's less. You're now starting old age security already. You may have already started your CPP benefit. You're already eligible for guaranteed income supplement. We have room to maneuver, but not as many options. So there's still value there, a little bit less. After 72, we're locked into a lot of decisions for retirement planning. We're locked into CPP, old age security, GIS, as well as RIF, LIF withdrawals. So after 72, we can do a couple things, but there's really not as many options available anymore. So the most value is 500,000 or less if you're a couple, 250,000 or less if you're an individual, and below the age of 63, ideally late 50s, 60, 61, 62 at the latest. Gives us a few years to sort of do some stuff. As we go through, you'll see where that will apply. Now, the other thing to highlight is that when we talk about low income, we don't mean poverty level income. We actually mean some fairly reasonable income levels, especially when we include old age security benefits. So OAS will not trigger guaranteed income supplement GIS clawbacks. And so for an individual, we're talking about up to 31,000 or so in income, including OAS, before GIS is fully clawed back. For a couple, that's 47,000 a year. And the two that I want to highlight here, which are unique cases, is if you're a couple but you only have one person receiving old age security, you can see the income threshold here is quite high. So that's an opportunity. And for a couple where they have a partner, younger partner that's between the age of 60 and 64, now allowance, GIS allowance is in the mix. Again, the thresholds are higher. So as you can see, there can be some relatively high income thresholds for GIS benefits, and you can actually qualify even for a few years if you find yourself in these situations. So don't think this is strictly for very low income situations. There are low and moderate income situations where you can certainly qualify if you set things up properly. And the value of this benefit is so high that it makes it quite attractive to maneuver through those rules. So let's talk about some of the rules. So guaranteed income supplement, it is tied to old age security. So it's a tax-free benefit. It is tied to old age security. You have to start your OAS benefit to be eligible for guaranteed income supplement. And really, it is a benefit that's worth a fairly substantial amount, up to 1,100 or so per month for an individual, 1,300 a month for a couple. One of the interesting things about this benefit, if we look at a per person basis, a couple gets about $650 a month. An individual gets 1,100. So this is one of those benefits that actually indexes a bit higher for an individual. Unlike some other benefits, some provincial benefits are a couple gets twice the amount of an individual. There's no sort of increase for individuals there. So this is one of those benefits that if you're an individual, lower income, that benefit can be quite substantial. Now, GIS is subject to clawbacks. So these clawbacks can range between 50 to 75% of taxable income. Taxable income means income that hits line 23600 your tax return. This is called net income. It's not really what we would normally see as net income, like on a pay stub. This is net income for tax purposes. So this line 23600 on your tax return is the basis for what ends up being the clawback calculation. Unfortunately, a lot of things hit that line. So pension income, CPP benefits, RSP, RIF, LIF withdrawals will all cause clawbacks. Um, you can see the rate there is quite high. This is why less of a concern. Sometimes we'll trigger more tax just to avoid GIS clawbacks because a 20% tax rate is nothing compared to a 50 to 75% clawback on GIS benefits. So what we mean by the clawback is that if you had just old age security income, so that was your only source of income, you would get the full GIS benefit, zero clawbacks because you didn't have any other taxable income whatsoever. If you had as an individual 30,788 of taxable income, including OAS, you would receive no GIS benefit. It would be fully clawed back by that point. In between, you'll get a certain amount of GIS, but it slowly gets reduced by that clawback until it reaches $0 at that income threshold. So at the very first dollar of taxable income, excluding OAS, you start to experience those clawbacks. Now, allowance is the other benefit that's very important to know. It is available to those between the age of 60 and 64 when they have a spouse who is also receiving GIS. So if you've got an older partner that is eligible for guaranteed income supplement or old age security, if they've started those benefits and you are between the age of 60 and 64, you are eligible for GIS allowance. This is an extremely generous benefit. You can see how much it's worth here. What this essentially is, it is the individual, the sort of $650 that a couple will receive per person, plus the old age security benefit. So even though you're not eligible for old age security, this is giving you the equivalent of old age security up to 5 years early. And so you can see how much is worth here. It's worth quite a bit. If you have a situation where you have an age gap, you and your partner not the exact same age, and your lower moderate income, it has to be on your radar because it can be quite beneficial. So we'll show you an example, the second case study, where this comes into play, and the benefits that they can receive are in the order of about $25,000 per year combined. So quite valuable. Now, what affects your benefits? Oh, any questions so far, Chris?
Just a few small questions. So one person is just mentioning that doesn't OAS also hit your line 23,600?
Yes, and it is exempt from the calculation. So the 23600, it's the starting point. But as we'll go through, there are certain exemptions. OAS income is one of those exemptions. So they'll back it out of that, whatever shows up on line 23600. Funny enough, GIS benefits also hit that line, but then get backed out on the next line. So yeah, there are, when you look at just that amount on your tax return, there are still adjustments. What they actually use is AFNI, AFNI, which is adjusted family net income. So yeah, a little bit more technical, but really anything that hits line 23600, other than OAS is potentially causing clawbacks.
Endpoints for Owen, remembering the line for our adjusted family net income. So the
Yeah.
other clarification, we had a couple of people just asking about that financial assets numbers. So
Mm,
saying both like, do those assets include your house, or what if I have more than those assets? So can you just speak to these aren't legislated asset ranges, and we're
yes.
not, and are we speaking about real assets, financial assets? What's considered there?
Yeah, okay, great clarification. So yeah, there is no means test for these benefits. Could be in the future. There's always speculation around that. So we changes as we move forward, especially with TFSAs. But really, what we're talking about is a general range where this type of planning can be quite valuable. We're really talking about financial assets here. So we're talking about TFSA assets, registered assets in an RSP RIF, locked-in assets in a LIRA LIF, really any of those sort of financial assets. I think there's a misconception that if you have 100,000, 200,000, 400,000 of financial assets, you don't qualify for these benefits. That's not the case. You can, in some situations, still qualify for at least a few years, especially if you're eligible for allowance. And it should be something you're thinking about. It doesn't apply. So if you have a rental property, that doesn't apply until you sell and you trigger a capital gain. Rental income would certainly hit that line 23600. Principal residence, totally tax-free. No impact there whatsoever. Even if you sell, your principal residence exemption means that there's no impact on GIS. The only exception is if now you have investment assets causing additional income, so non-registered assets. And we'll kind of go through what triggers clawbacks. But yeah, good clarification. This is not a means test. This is just a general rule of thumb of if you're in this range, please be aware GIS should be a factor, or at least something you explore.
And then a last question is just getting where you were for your slides. Somebody's just wondering if you delay or defer your OAS to 70, 71, the benefits are greater, but how does that affect GIS?
No GIS. Yeah, you have to have started old age security to qualify for GIS. Those benefits are tied. So delaying OAS, never a good option if you're eligible for GIS, even for a few years. So yeah, very important planning consideration. It's definitely tied together. Yeah.
Okay, great. Thanks, Owen.
Perfect. So let's talk about a couple of those things that affect your GIS benefit. We've got employment, self-employment income. And we're going to talk about each of these specifically because there actually are some exemptions you should be aware of if you're doing this sort of planning or getting into these details. So employment, self-employment income will cause GIS clawbacks. Canada Pension Plan will as well. It's fully taxable. So will RSP RIF withdrawals, as well as LIRA LIF withdrawals. So those are all registered, fully taxable withdrawals. Non-registered investment income will cause GIS clawbacks, in particular, the gross up on eligible Canadian eligible dividends. So watch out for that. But any principal withdrawals, there's no GIS clawback. That's already, you've paid tax on that income already. And the last one is DB pension income, defined benefit pension income, also fully taxable, also causes GIS clawbacks. Let's go through each of these specifically because there are some exemptions you should be aware of. First one, employment, self-employment income. There is an exemption for the first $5,000. So if you're eligible for GIS, if you're receiving that benefit, you can earn up to $5,000 per person and not impact your GIS benefit. And the next $10,000, so going from 5,000 to 15,000, only incurs half the normal clawback. So normal clawback being 50%, you would have, in this case, only a 25% clawback for that next $10,000 of income. These are important thresholds because you can still earn some part-time income in early retirement and not trigger some GIS clawbacks or trigger lower GIS clawbacks. So important thresholds to keep in mind. You don't necessarily want to go over 15,000 because then all of a sudden you're experiencing the full 50% clawback. It's like getting a 50% tax rate on any income you earn. You want to think about whether or not that's worthwhile. So employment, self-employment income, two good thresholds to keep in mind. Let's say, as an example, we've got Rick here. Rick's earning $5,000 of employment income. Because of the exemption, there's no income to trigger the clawback. So even though it's included on line 23600, the exemption, the adjustment means that there's no clawback for Rick, which means he's experiencing no clawback on GIS. If Rick were to earn $10,000 of employment income, we would have the initial $5,000 exemption, an additional $2,500 exemption, which is half of that 5,000 additional in employment income. So what would cause clawback is only the 2,500. And if we kind of look at that benefit, Rick would then experience a reduction in the annual benefit of $1,200 the following year. So 50% of that 2,500 would hit next year's GIS benefit, the annual benefit. Still overall worthwhile. Rick's earned $10,000 of employment income, only seen his GIS benefit go down by $1,200, $1,250. So it still could be very much worthwhile for Rick to earn that additional income. Any questions on the income exemption at all, Chris?
Not so far.
Okay. Canada Pension Plan. It triggers the full clawback. There's no exemptions there. And so we do want to think about CPP, specifically the timing. So there are two strategies here. You can start CPP early, and that will have a lower benefit You might even start this while you're still working. You might use that income to top up a TFSA, and we'll go through an example with that. Um, but the benefit here is that you are getting that income early, and the annual benefit you receive later on is lower. So if you're only getting $4,000 a month, you're only experiencing a 50% clawback on that 4,000, so $2,000 reduction in GIS. The other strategy is to delay it to as late as possible. This works very well in certain situations because for 5 years, you can have very low taxable income as you delay that CPP benefit from 65 to 70. So if you've got a bunch of RIF-LIF income in the future and you can't avoid it, this can be one way for at least 5 years where you can qualify for some GIS benefits. So again, even if you're in that 250,000 range, 500,000 as a couple, even if it's all in registered assets, you could potentially have 5 years of GIS benefits if you delay some of these withdrawals in CPP income. So we'll show you some examples as we go through, but that's the timing can be very important there. RSP RIF withdrawals, full clawback. So we're experiencing the 50% clawback on GIS. This is the reason why RSPs are really not good for lower income retirees. So lower and moderate income retirees, we want to be focused on TFSA contributions. We've seen lots of examples, Chris and I working with individual clients where their advisor not knowing the rules has them contributing to an RSP every year. They might get a bit of tax benefit on those contributions to the RSP, but they're going to get hit by some very hefty clawbacks when they start to withdraw. So in general, if you're in that range of qualifying for GIS, RSPs are an absolutely not a great option in your case. To give you an example, let's say we've got Rick earning 45,000 a year in employment income. Rick could add $2,000 in an RSP contribution, would get $440 in tax benefit, tax reduction in the year that Rick makes that contribution and deduction. The problem is when Rick withdraws that money in the future, he could experience anywhere from 50, 75%, even higher clawbacks depending on the other provincial benefits. So that $2,000 contribution and subsequent withdrawal could cost him $1,000 or more in GIS benefits and other benefits. So even though there's a small tax savings on the contribution, there's a huge penalty when withdrawing that money in the future. So thinking about the whole life cycle of the RSP is very important for lower moderate income retirement planning. Lira LIF withdrawals are similar, fully taxable, full OAS clawbacks. Very difficult because we can't draw this down the same way an RSP can or a RIF. We don't have the options we do. We potentially, depending on the province, we have maximum withdrawals we can make. Um, we definitely want to explore options like melting this down quickly, using small balance unlocking rules, 50% unlocking rules. This LIF account can be a bit restrictive and make GIS planning particularly difficult. So if you've got that account and it's sizable, definitely think about how you're going to unwind that in the future. Non-registered investment income, so any sort of investment income you're generating, interest, dividends, capital gains, will trigger GIS clawbacks. Watch out in particular for Canadian eligible dividends. The gross up hits line 23600. So not only does the dividend income cause clawbacks, but the gross up does as well. So very annoying if you've got a lot of Canadian eligible dividend income. Great for tax planning, not great for GIS. And then DB pension income. One of the challenging things about DBB pension income, it can be great if you're getting 30, 40, 50,000 a year in DB pension income. If you've got a defined benefit pension that pays you 5 or 10,000 a year, and you're in the range of qualifying for GIS, it can be tough because you're getting 5,000 in DB pension income, but triggering $2,500 of GIS clawbacks. So the net benefit to you is really only $2,500. So it can make smaller DB pension payments fairly unattractive. We might even look for other options to maybe get some lump sum benefit instead. So if that's your situation, watch out for those little DB pension payments. Now, what doesn't affect GIS? Well, old age security, as we talked about, it's exempt from the GIS calculation and TFSA withdrawals. That might change in the future. TFSAs are getting quite big. Lots of speculation around how that's going to affect GIS going forward. But at least at the moment, they don't trigger any GIS clawbacks. Now let's talk about strategies. So we're going to go through case studies. But any questions so far, Chris, actually?
No, there've been some questions that I think we're going to cover as we go through things here. So I'll leave you to continue, and then I'll let people ask them kind of her follow-ups if it doesn't completely answer the question.
Okay, yeah, we'll go through the examples and then we'll do a follow-up. So there's four strategies we want to consider here. CPP timing, we talked about that early or late. Both options can be viable depending on the situation. RSP meltdown. Can we get rid of those RSP assets? It's not great for GIS planning, lower income, moderate income retirement planning. Can we get rid of it before retirement? This is where pre-63 planning becomes very important. Or can we get rid of it later on in retirement? Can we do a quick meltdown and get rid of those assets? We'll show you some examples of how that can work. RSP contributions. Interestingly, an RSP contribution, because it's a deduction when you file your taxes, it lowers the amount of income on line 23600. You can actually use that to essentially offset other sources of taxable income. You can be getting CPP benefits and you can make an equal sized RSP contribution and you can essentially zero out the impact on line 23600. So strategic RSP contributions after the age of 65 can actually be quite beneficial. And then TFSA maximization. TFSA is an amazing account when it comes to GIS planning. As we mentioned at the moment, there's no impact from TFSA withdrawals. There's no means test for GIS benefits. So this can be quite a valuable tool if we have a sizable TFSA account as we enter into retirement. Let's go through a couple examples, and then we'll do a couple live case studies as well. In this case, CPP early, we'd get $4,300 of benefit in this case. Even while working can be a good option in some situations. So we can put that money in the TFSA, we can build up TFSA assets, and we can also reduce future GIS clawbacks because we don't have such a large CPP benefit in the future. So can make sense in some situations. So can starting CPP later. So even though we have a higher CPP benefit after age 70, it can help us qualify for additional benefits 65 until 70. So for 5 years, we could qualify for more, which maybe ends up working out better in some situations. So definitely look at both options when it comes to GIS, lower income retirement planning. And then the other thing we want to think about is an RSP meltdown pre-63 if we can. Again, we want to get rid of those RSP assets, even if it causes extra tax. This is the thing, the counterintuitive thing about lower moderate income retirement planning. Sometimes we're paying more tax to avoid higher GIS clawbacks in the future. So very counterintuitive. Difficult to explain if you're working with an investment advisor, but can be very strategic, very beneficial if you're going to qualify for GIS in the future. If you can't withdraw that money when you're working, maybe it's a group RSP and you're still contributing, whatever that reason is, you can do a later meltdown. So age 71, 72, when you have to do those minimum withdrawals can sometimes be an option as well. So very quick, rip off the Band-Aid, avoid the death by 1,000 paper cuts from those annual withdrawals for the rest of retirement can also be a good option as well. So we'll show you both of those as we go through the case study. The last one is that RSP contribution. So as an example, we've got CPP of $4,700 a year here. We would make an RSP contribution of the exact same size. So there's no other income sources. There's just GIS, OAS, and a bit of CPP. We can withdraw from TFSAs. But to offset that CPP income, we can make a very strategic RSP contribution. Now let's take a look at a couple of case studies, unless there's any questions, Chris.
No, let's jump into the case studies.
Okay, so number one, so we've got Rick here, 58. Rick's got 220,000 in financial assets, 0.5% fees, 70/30 investor. We've got retiring at age 64, wants to spend 35,000 a year. Questions are, how do we maximize GIS? When should we start some of these benefits? So we've got time to maneuver. This is good. let's take a look at this example and see what we can do for Rick here. So let's go over to the example here. We'll talk through first what the base case looks like. So let's see what if Rick were to do a traditional retirement drawdown. Let's see what that looks like. Then we'll start to optimize it. We'll look at CPP early and late. We'll see what we can do in terms of optimizing this plan. Right now, if we were to do more traditional retirement drawdown, from an income perspective, we might have Rick retire at 64, start drawing on a registered account first. We would start CPP and OAS at 65, for instance. And certainly Rick would qualify for some non-taxable government benefits in the future, but only after transitioning to TFSA withdrawal. So we've got, 8.5 years here, where we just don't get a lot of GIS benefits or other provincial benefits. So a lot of missed opportunity in this example. Spending 35,000 a year, 30,000 a year in late retirement. And you can see not terrible. We definitely do have a bit of room, but if Rick gets some poor investment returns, high inflation rates, definitely a chance of running out of money here. So as early age as age 73, but certainly in Rick's mid to late 70s is a risk. So can we do better? That's what we're going to take a look at here. So let's start. Let's make a copy. Let's go through CPP early first. So let's rename this one. Let's call it CPP early. And let's go through. We're going to use the AI strategies first. In some cases, you do need to make manual kind of contributions withdrawals. I'll show you what that looks like as we do manual RSP contributions. But depending on your situation, the settings, retirement age, etc., you might need to do a bit of this manually. Let's start with CPP. So let's focus on that one. Already the AI strategies are saying the best option is to start this benefit early. So that's great. We can just enable that one. And then the other thing we want to look at is that RSP meltdown. And in this case, it is also the top strategy, enough to be right under the OAS clawback threshold. So we're going to enable that one as well. Now, before we recalculate, let's look. Right now, Rick had in the base plan $4,300 estate value, 52% success rate. Let's see what just those two changes do for Rick here. Um, Already we're at 81,000, so that's a big change. So 75,000 in additional value. Remember, Rick only had 220,000, 222. So we've added, what's that, 30%, a little bit more. So quite beneficial. And 71% success rate. So already good. Let's see if we can do it a bit better. We've got registered withdrawals before the age of 63. So Rick gets the entire registered account drawdown by 61. We've got CPP here. We're making contributions. That's all going to the TFSA. So we can see here, TFSA is getting quite big. We even have a non-registered account, so we're running out of TFSA room, but that's fine. We're going to just fill up that non-registered and draw down first. So that's not a big deal. And success rate already looks better. So now we're pushing late 70s before we have a major risk of running out of money. But there's one more thing we can do, and that is offsetting this CPP income with an RSP contribution. So again, some of this we have to do manually. Let's go down to the table. Let's grab at age 64, we're going to grab Rick's CPP amount, and we're going to scroll all the way to the right to the investment accounts. We're going to open up a Rick's RSP using the arrow here, and we're going to make a contribution of the exact same size. We're going to do this until the age of 71. That's the last age we can do it. 72, we have to start withdrawals. Let's save that. We added inflation because CPP goes up by inflation. And let's see what this looks like now. So we had 80,000, 71% success rate. Now we're at 95,073. So we've added 2 points to success rate, a good chunk to the after-tax estate value. We do have to draw down that registered account. So we sort of built it up 65 to 71, draw down one big foul swoop. But we do help Rick qualify for max benefits here. So 14,000 a year when we add other benefits. And there's a number of years here where Rick can qualify. Any questions about this example so far, Chris? Maybe we went through a bit too fast, but yeah, just let me know.
Oh, yeah. So one kind of just clarification. So does GIS appear as no other non-taxable income on the chart?
At the As we have had a few feature requests to separate GIS into its own column, so that's definitely in our roadmap. We will add that for clarity in the future. But yes, it's all lumped in here to other non-taxable income. If I go down into the table and I scroll back to the left here, if I open up again Rick's income, we can open up government benefits and we can see the type of benefits Rick's eligible for. So we can see the GIS benefit, GST, HST credit, etc. So if you want to see those details, you definitely can. We will separate out the GIS benefit just to add additional clarity and visibility. We have it in the lifetime totals, but I think it would be helpful if we can have that visually in the chart as well. But it is lumped in with some other smaller benefits. Yeah.
Next question. So somebody's wondering, how do you balance investing while minimizing GIS clawback for somebody who is over 80, has a fair bit to invest? So let's say 200K. What strategies would be leveraged? And they mentioned T-series funds.
Yeah. So, I mean, as advice-only planners, we can't recommend specific securities, comment on them. So, I think it's something that you definitely need to think about after understanding how the types of income can impact your GIS benefit. If I were to think about it, and again, we don't want the sort of tax tail to wag the investment dog. So we don't want to make investment decisions purely from a tax and benefit planning standpoint, but certainly things like a capital gain, because it's a 50% inclusion rate, a capital gain would be preferable to investment income from like interest, dividends, foreign dividends. Um, I would say probably Canadian eligible dividends are one of the worst types of income in a non-registered account just because of the gross up. So yeah, can't comment specifically about different investment assets or different investment options, but certainly think about the type of income being generated, the risk, but don't make that decision. Don't make it solely based on benefit clawbacks or tax planning. Always look at the bigger picture, asset allocation, the type of investment first. Yeah.
Great. Thanks, Owen. So I also want to just kind of speak to, we had a question that a user kind of emailed in beforehand and wanted to kind of look at. So what they were trying to do, it's not specific about this example, but it has to do with GIS planning and trying to have the platform include the previous years, based the benefit on based on the previous year's income. So can you give us some options for how to do that with the platform? And maybe if it's not possible, like it's actually in this scenario, might not be, how can they kind of do a workaround?
Yeah, okay. So I think probably the question relates to a specific form that you can file with Service Canada. It's ISP 3041. That form allows you, when you first start retirement, it allows you to base your GIS benefit on your current year's income. So if you're like Rick here, you've retired, you've got employment income in your previous year, um, the basic GIS calculation would suggest that you don't get any GIS benefit until you have a lower income year. So the problem is when you first start retirement, that would essentially disqualify everybody who had previous year's employment income. So if you call Service Canada, this actually isn't a form you can get online. You have to call them, you have to request it, you have to fill that out. But the way to model it on the software is that you would go down here to the income. You could override. So we can see here Rick's first year, age 65. We've got a partial year of GIS. Rick does have low income at age 64, but if Rick was working age 65, this might even be zero or very low as well. So in this case, we could actually override this number with an estimate. So we can see next year's around 15,000. We could override it with an estimate. The platform won't do this automatically, but you can certainly do this if you are fairly certain that you can qualify for that form ISP 3041. So that would be the easiest way to do it. I would say make an estimate. It doesn't have to be perfect, but within a few $100s, 500 to $1,000 is going to certainly make a difference for your plan. So um, just make sure you take into account your date of birth. If Rick here was born earlier in the year, we might get a full year of benefit. If Rick was born in July, then it actually wouldn't matter because Rick would only be eligible as of his turning age 65 anyway. So make sure you take all that into account, but certainly override the platform if you feel like you're going to qualify for a bit more than what it might be calculating. Yeah.
Great. Thank you, Owen. That's great. I don't think we have any other specific questions about this one, but
Okay.
please, if you want us to clarify something or go over something, just let us know.
Excellent. Let's look at a CPP late example. So we saw CPP early. Let's look at the CPP late just in case Rick can't make that withdrawal earlier in his plan. So let's do CPP late. And let's see how we can set this up here so you can also model this in your plan. Again, maybe we can't do this in a certain situation because maybe Rick can't make those RSP withdrawals. It's a group RSP, it's something different. So let's do this. Let's first delay CPP benefits. So we're going to delay CPP until age 70. And in Rick's plan, we're going to do that RSP meltdown, but the first thing we're going to do is we're going to override, we're going to come down to the table, we're going to override that group RSP because we know we can't make withdrawals until a certain point. So we're going to override it to 0. We're going to do that until the age of, we're actually going to do it to the age of 69. The reason being, Rick already gets CPP at age 70. So we'll just say that at that point we can start doing the RSP meltdown. So if we do that, we've overridden the platform to 0. It won't be able to make withdrawals. It's going to use the TFSA assets first. In this case, it is helpful, not as helpful as before. I think we're over 100 grand before, or maybe 95, 98. Not as good a success rate. But again, if Rick doesn't have any options about melting down the RSP earlier, doing it later, delaying CPP, getting max benefits for 3, 4, 5 years between 65 and 70 certainly is an option in this case. Not as good as an option, but definitely better than the base case scenario. So if this is something you want to explore, if you've got other income that starts at age 70, DB pension or RIF-LIF withdrawals, then this could be another way to go. At least you get 5 years of benefits there. And if we compare, unless there's any questions, Chris,
Nope, let's compare.
if we compare these options, so this was the first one. This is the one where we just had the traditional RSP drawdown, switching to TFSA later. We didn't end up with a great estate value. If we did the CPP early, where we also melted down the RSP, we certainly triggered a lot of tax earlier in the plan. This does decrease the overall net worth, but of course, that was tax we had to pay at some point anyway. So quickly, this one starts to win out, and overall, it ends up being quite a bit better. So 95 versus 4,000, gaining $90,000 there. And again, Rick was only starting with 222. So almost 40 to 50% improvement. And if we look at CPP late, not quite as good, but certainly still much better than the base case option. So if you're stuck, if you can't withdraw that money, if it's locked in, if it's a group plan and you can't make withdrawals pre-65, doing that later, starting CPP later, at least gives you 5 years of max benefit. So could be a good option to explore as well. And overall, you can kind of see here, way better success rate. We haven't done anything to add income. We've not changed the investment returns. All we've done is we've decumulated these assets in a much more smarter, more intelligent way, given what we know about those benefit rules. So certainly high value planning if you find yourself in this situation. Now, should we switch over to the other example, Chris?
Yes, let's do it.
Okay, so let me pull it up here. We'll just walk through what this looks like first, and then I'll share the screen. So we've got, again, Rick here. Rick's a bit older in this case, 63. And we've got a partner, Hannah, who's 58. Very important here. We've got a 5-year age gap. So that is critical If you, in your situation, you and your partner, common law, spouse, married, if you have an age gap, you need to think about old age security, GIS and allowance. So that will be a factor in your plan if you can qualify. Same total overall assets, same investment fees. They're targeting 45,000 a year, and very common for couples with an age gap. When Rick retires at 65, Hannah's going to retire as well. That's age 60. So we'll take a look at when they should start CPP and OAS and how to max some of those benefits out. So let's go over to the example here. We'll walk through the base case again, and then we'll optimize together. So, first example, again, we've got them retiring here. This is Hannah's age at the bottom, by the way. So we've got Hannah age 60, Rick 65. They do the traditional RSP draws first, then they switch to the TFSA. They get some sizable GIS, non-taxable benefits later, um, and they still get some even while making those registered withdrawals. And again, remember those thresholds are much, much higher when you have an age gap, when you're getting allowance, when one person isn't getting their OAS benefit yet, the thresholds for income are in the $50,000 to $60,000 range. So here we still have some benefits because actually taxable income is only in the 42,000 or so range. So they're still getting something, but just not as much as they might be eligible for. Spending again, 45,000 a year. We've got a shortfall already. We know that that's not great. They are definitely racking up some debt later in retirement, so we don't like that. And we don't have a great success rate, 43% success. 57% of the time we're running out of money. So not a great plan. We want to do better here for Rick and Hannah. So let's start with some of the traditional ones. Let's look at that RSP meltdown first. And we're going to do RSP Meltdown and CPP later. So let's take a look at that one. So let's rename this. So RSP Meltdown plus CPP late. Let's start here by doing CPP later, or we could do RSP Meltdown. So let's take a look. We've got RSP Meltdown. So fairly sizable withdrawals here. It's already suggesting pretty big change in after-tax estate value and success rate if we can just get rid of those registered assets before they get to retirement. So in the 2 years while Rick's still working, let's take a look at what this looks like because it's going to be pretty big in terms of withdrawals. So fairly big withdrawals, lots of tax, but if we look here now, they're instead of 6,000, I think it was, now they're at 21,000 in benefits. Again, allowance plus GIS, quite substantial, and no clawbacks later, so they're getting more benefits later on as well. Already now, we don't have a shortfall. We've got assets later in retirement, 70% success rate. So that alone, just that one change, quite beneficial. Let's also look at CPP at 70 as well. So let's move out that CPP benefit. Already says this is good for Rick, so let's do that. So that's going to give us another 8% on the success rate. It's going to give us another almost $50,000 on estate value. So let's do that one. Pushing it out means we qualify for more GIS there. So that's why that's happening. For Hannah, same thing. So we're getting not as much benefit, but definitely an additional benefit. So let's do it for Hannah as well. Okay, so we've done an RSP meltdown. We pushed out those benefits. We're getting now the max. And again, remember I said that that benefit combined allowance plus GIS, very generous. 3 years here, 75 grand. So again, if we can qualify, it can be quite impactful. Let's see what else we can do. So good success rate, good after-tax estate value. Let's make a copy of this. I want to show you what happens if Hannah can work a little bit in early retirement. So maybe it's not a full retirement, but we've got some employment income. And again, the platform will take into account the exemptions. So let's go down here for Hannah. Let's say we have 15,000 a year, and we're going to do that from 60 to 64, so 5 years until Hannah's 65, just some part-time income. And let's see what that looks like. So we've got 111,000, 86%. Now we're at 315, so lots of room here. We're still getting the max benefit because of all of the exemptions. And in fact, actually now Hannah's going to qualify for the Canada Workers Benefit. So that's why we're still at that $25,000 range. 100% success rate. And now we could actually look at spending a bit more. We've got a situation where now they've got room. They could spend a bit more in their plan. So let's copy this. Let's rename it and say plus. Let's call it extra spending. Um, Probably can't do this all the time, but if Hannah can do those 5 years of employment income and they get some good investment returns, let's look at modify retirement spending. Let's reorder by lifetime spending. So let's look at higher spending first. They can't do that much, but what can they do? Adding 6,000 a year until Rick's age 75 only drops their success rate to 90%. So let's enable that and see what that looks like. So now we've got some TFSA withdrawals mixed in. We've got higher spending, 51,000 a year, then dropping to 45. Um, does kind of decrease their overall net worth estate value, but still some extra buffer in case they need it. And success rate's pretty good, 90%. So even they might be able to push it a little bit further in the future as well. But this definitely maximizes their spending, navigates those rules, those government benefit clawback rules in the most intelligent way. And certainly big improvement. The last sort of the first plan that we did, I think was negative 50 grand. Now we're still up and we've added spending as well. Any questions so far? I think we went through that one fairly fast.
We did. I'll leave some space here. I'll just let everybody know we're kind of running to the end of our session here. So if you have any questions and really want us to speak to anything, just let us know so we can make sure to get to them. I answered this a little bit before, but I think it's worth highlighting because it's similar to the scenario you just said. So somebody had mentioned that their wife was younger, they're 61, and if their OAS CPP plus pension income was below 53K, 53,000 per year, could they still qualify for GIS? And as you were just looking at the scenarios, potentially.
Yes.
And especially with an age gap, there might be some interesting opportunities, at least to test using some of the things that you would. But do you have anything else to add to that?
No, I do think that's interesting. So if we're in this range, 49,000 being the cutoff at the moment, 61 if only one of them's receiving OAS benefits, um, and making some RSP contributions could lower that income. So you could sort of shuffle money around, take money from a TFSA, put it into an RSP, lower your on paper, your taxable income, and still qualify for a few years. So the thing to keep in mind is that once you both start OAS, you don't qualify anymore. CPP, OAS, GIS, or sorry, CPP, OAS, and the pension means you wouldn't qualify. I think you mentioned 51,000. So this is one of those situations where if you can qualify for a few years, still it could be quite beneficial to your particular plan. So yeah, definitely explore that option.
But there's the deferring CPP option as well. So if that CPP can be pushed to 70 to take you under. So this is where testing, using exactly what Owen's been saying about saying, try delaying, try taking it early, especially with an age gap, there's real an opportunity there.
Yeah.
Um, Another question here. So when you're talking about spending amounts, are we doing the calculation to take into consideration the rising cost of living?
Yeah, so that's a good question. Let's go back here to the platform. You'll notice that all of the charts are in today's dollars. It's a bit easier to comprehend just because, the CPP benefit goes up with inflation, OAS goes up with inflation. Um, it's easier, especially from a spending perspective, to think about spending in today's dollars. Like, what does 51,000 buy today? How will that, what will that purchasing parity look like in the future? But if you click future dollars, we can see what the platform's doing is it is inflating that amount every single year. So when it's doing those withdrawals and all the calculations, by the time Hannah's 69 and Rick is 74, their purchasing power is 51,000 in today's dollars. their actual outgoing cash flow is going to be 64 in that year, assuming we get that sort of inflation every year of 2.1%. So, yeah, good question. It's definitely inflating that cost of living every year. Everybody experiences inflation differently. So, depending on what you're buying, what that looks like, you could be below or above the average inflation. So, not everybody's going to experience that the exact same way. So, it's always good to update the plan every year. You might see that your spending's gone up more than inflation just because of the things you're buying having to get hit a little bit harder. So, definitely why updating the plan every year becomes quite important.
Great. I think we have time for one or two more questions here. So, does the Canadian dividend gross up also potentially claw back other government benefits like senior homeowners property tax credit, Trillium, GST rebate, etc.?
Yeah, all of them. Yeah, because they're all, for the most part, based on that line 23600. There are some benefits based on line 15000. So that could be, I think in BC, there's like a rental benefit. I can't remember the exact name. It's not built in the platform because it's fairly specific, but yeah, for the most part, you're going to see that gross up hit all of those benefits, including old age security benefits. So when we talk about old age security clawbacks at the higher income levels, that's a factor. If you've got a bunch of Canadian dividends, yeah, great from a tax perspective, but actually triggering a bunch of OAS clawbacks. Maybe overall that's still okay, but it's not as good as you might think it is because of the OAS clawback being triggered.
This is the plug for running your platform, your plan through something like Advice, because it's really hard to look at these things in an isolated way. You can sit down with somebody and say, look, it's so obviously the right tax choice, but you pull one thread on the sweater and it moves other things. And so trying to encapsulate everything that it touches is a tough thing to do. And
Super tough. Yeah.
yeah,
And
which we try to make
decisions
easy.
early. Yeah, try to make it, yeah, exactly. To see what that decisions early in the plan affect, things later in the plan. So, like we saw that RSP meltdown looks crazy at first. You would trigger so much extra tax when you're still working, but actually works out so beneficially in this particular situation. So, um, yeah, the funny thing is, Chris and I have experienced this. We advice only planners. We work with clients who sometimes have an investment advisor. Sometimes the recommendations we make are so counterintuitive that we actually get pushback from the investment advisor. They're not comfortable making those size of withdrawals. They don't understand the strategy. If you're in that situation, we would always recommend use a third-party resource. Use something like John Stapleton's low income guide, low income retirement planning guide, John Stapleton, Open Policy Ontario, something good you can share to help educate the investment advisor about why you're asking for these oversized withdrawals when maybe they wouldn't normally consider making them. But yeah, you'd be surprised at the pushback we get sometimes.
Or contributions. So making, if you're somebody who's trying to offset RSP contributions from 65 to 70, I've had calls from people at the bank saying, you told your client who's 69 to put money into an RSP. I'm like,
Yeah.
yes, but there's a benefit that you're not looking at. So you may experience some of that pushback. And like Owen said, I just dropped the link for John Stapleton's guide. He updates it every year. It's a really great resource and another good way to look at. We've explained it in one way. John explains it in a bit of a different way. Same fundamentals, but it's a nice way to kind of take a look at. And he especially takes a look at with a focus on new Canadians. So if that's your situation or somebody's situation in your life, there's a lot of really interesting specific on partial benefits, partial GIS, partial OAS, which we have not touched on today, and how it touches other benefits. So things like disability benefits and other social benefits that also may intersect. So there's some really good information in that guide on those things as well.
Yeah.
So
This is a very nuanced area of planning for sure.
completely. And really, John is a great place to start just because very few people have done as much work as he has in that space. So he's a really good person to know. Thank you so much for joining us and to talk about low income planning. We really appreciate it. As always, if you have questions, the best place to send them is to our Reddit forum. We're on there a lot. You can post anonymously and we'll get to the questions as soon as possible. We appreciate it. And next month we'll have two sessions, one office hour session earlier in the month, and then later on in the we're going to take on investing in retirement. Specifically, going to see if we can ruffle some feathers by challenging some of the maybe standard tried standard beliefs about how people should invest in retirement and try to show you some other ways to think of it and ways you can test it on the platform. So have a great month, enjoy your summer, and we'll see you in a couple weeks.
Thanks, everybody. See ya.